Hello, and welcome to our latest installment of Spartans Step Up. This web series is coordinated by the Alumni Association of Case Western Reserve University. I am Scott Fine, Professor of Banking and Finance at the Weatherhead School of Management. Our broadcast today will focus on how technology is impacting access to the stock market by leveling the playing field and changing the impact individual investors have on the market. Our two panelists today have firsthand knowledge of the intricacies of the stock market, as well as how technology is impacting the market. Joining me are two folks. The first is my colleague, Professor Greg Harmon, who is Assistant Professor in the Banking and Finance Department. Professor Harmon is an experienced investor, trader, and former banking executive with more than 2 decades of experience at institutions including BNP Paribas, State Street, and JP Morgan. He's also authored the book Trading Options, Using Technical Analysis to Design Winning Trades. Welcome, Professor Harmon.
Hello, everyone.
Our panelist also includes Darius Inzar, who graduated last year with a degree in civil engineering and has come to the right side of the coin at the business school. He's currently in the Masters of Finance degree program at Weatherhead School of Management. Darius is also an active user of financial technology platforms such as Robinhood. Welcome, Darius.
Hi, everyone. Thank you for having me.
So let me start with a question for each panelist, and then we'll go to questions that have been submitted by many of you in the audience when you registered, and we've been fortunate to have gotten a number of questions. We're grateful for all of your questions, and we'll get to as many of them as possible. So, Professor Harmon, let me start with you. You have a lot of experience in the stock market over, as I said, 2 decades. How would you describe the current state of the stock market, which I know is a pretty broad question?
Yeah, it is a pretty broad question, and most people would start to answer that question by talking about what's going on in the market, what's going on with prices in the market. And it's been a really great time to be an investor in the market in terms of stock prices going up. We've got lots of stimulus coming into the market through checks going into every participant in the country. And a lot of the money's finding its way back into the market. But probably more interesting than that is the revolution that's happened over the past 15 years that's allowed the retail investor to get access to the same kind of tools that institutional investors, those professional money managers have, that in the past, 20 years ago, would have cost them hundreds of thousands of dollars, are now available to the individual investor for free. And I know we're going to talk a lot about that today, but this is something that's driving, I think, the rising prices in the stock market, as well as all the stimulus and other professional issues that we'll talk about along the way. It's a great time. It's a golden age.
So that's a great answer, and I appreciate that. Darius, let's turn to you and talk about one of the platforms that's really been in the news quite a bit, Robinhood. And I want to ask you about kind of what Robinhood is and what kind of stir it caused a few months ago. We can talk about GameStop, which is probably the stock that was most closely associated with this whole topic. So give us a little bit of background on Robinhood, what it is, how people use it, and how it caused a stir with some stocks, including GameStop.
Yeah, definitely. Robinhood is just an online trading platform where users can buy and sell stocks, ETFs, options, and other financial securities. The platform is significant because it was one of the first, if not the first, platform to do all of this without commission fees. Instead of making money on commissions, they sell the trading data from its users to other firms and hedge funds. Trading costs were arguably the biggest factor in limiting non-wealthy and young investors from entering the market. Just like Professor Harmon was saying, Robinhood is part of the wave that really started with bringing in these young and these young investors into the market. It simply made little sense for young investors to come into the market because the costs were too high. Robinhood is the preferred trading platform for newer and younger investors, and they have in a way democratized these investors and allowed them to participate in the market. Robinhood caused a stir a few months ago because of its role in the epic short squeeze that we saw in the GameStop stock. We also saw this in AMC and BlackBerry and other highly volatile stocks. The squeeze was mainly led by these retail investors that were basically sitting at home and not doing much because of the pandemic, and they saw the stock market as a way to essentially gamble in one way or another. But they got involved in the market, and GameStop stock became simply a fight between the bigger hedge funds and the lowly retail investor, and that mainly happened on Robinhood's platform.
So thanks for the answer, Greg. Greg, I'd like you to address that as well, and perhaps because not all of our folks in the audience know what a short squeeze is, and the difference between an individual investor and a large hedge fund. Perhaps you can dig a little deeper into what Darius talked about, what that really means. And then really, as part of that question, step back. I know you and I are about the same age. We're not as young as Darius. We've been around for a couple of decades. How has this all changed in the couple of decades, 3 decades that you and I have been around? We never would have imagined this, I think, when we were Darius's age. So let's start with kind of understanding what a short squeeze is, the role of the hedge fund versus Davy versus Goliath, and then maybe kind of give some historical context.
Yeah, so a short squeeze is caused when investors have bet against the price of the stock. They're betting that the price of the stock is going to go down. So the most common thought around that is that they're betting that a company is going to go bankrupt or lose a lot of money, so that the investors will look to sell the stock short. They do that by borrowing stock from other people that already hold it to facilitate the sale of their stock. The thing with being short a stock, betting on the price going down, is that you have to close that trade out at some point in time. And when you're closing your trade out, that is buying stock. That's the only way to close out that trade. So what happens in a normal short trade is that an investor will sell the stock short. And if they think that it's reached their price target, if they think that it's gone far enough down in value, they'll just buy their stock back. But oftentimes, things will happen along the way that make it more difficult for that. And GameStop was a good example of that. If we even take GameStop out of the equation and look more generically at a short squeeze, when an event happens that changes the perspective on the investment in a company, where all of the investors have been selling the stock short, thinking that the company is going to go bankrupt or to go down in value substantially, if news comes in that significantly changes that, the price will start to rise rather rapidly. And at that point in time, all of those people that sold the stock short start to get into positions where they may be losing money. And as they're losing money, they're all looking to sell, or they're all looking to close their positions, so buy their stock back. And it becomes this race to see who can get out the door fastest, who can close their position the fastest. And as that happens, stocks that might trade, 5 million shares in a day may end up trading 20 million shares in a couple of hours. And if you remember back to your days of Econ 101, supply and demand, look at this in terms of supply and demand for stocks. All of a sudden, you've got triple, 4 times, 5 times, 10 times the demand for stock that you had a couple of hours ago or a day ago. The price of the stock can shoot up very fast. And when that happens, we call that a short squeeze. And short squeezes facilitate more and more higher prices as more and more traders and investors that have been betting on the price to go down have to cut their losses, either because they feel they can't afford it, or because their broker does it for them automatically.
And so contrast a little bit what you see now versus what we would have seen 20, 30 years ago. The presence of these large groups of individual investors is very different from what we would have seen many, many years ago.
Yeah, so as Darius had said, the rise of the retail investor, you and me, mom and dad, people, college students, everyone who's been sitting at home during the pandemic, bored, getting their stimulus checks, spending their time on Zoom calls, but on the side, deciding, well, I'm going to take advantage of this time and learn about trading. All of those people have been finding different ways to communicate with each other, to gather information. They're doing it in chat rooms. They're doing it on this product, Reddit. There's forums that have come forth there. There's Discord servers. There's all sorts of new technology that allows people to communicate. And some of these communities have gotten to the point where they are so ingrained with each other and helping each other out that, as Darius had put it earlier on GameStop, we saw that many of them started to band together to recommend and discuss about the possibility of going to buy stocks that had very high short interest in them. So the large amount of the shares of the company had been sold short. And therefore, they would have to be bought back at some point in time if there were a short squeeze or if there were a change of events.
So
we saw that happen with GameStop.
So that's very, very helpful. And Darius, I want to come back to you. I think I like the description of this as the democratization of investing. I think many, many years ago, maybe not even many years ago, institutional investors were really the groups that drove the market. It used to be what are called kind of long-only fundamental investors like Warren Buffett, who were investing in the quality of the industry and the company. And then hedge funds became a very, very important influence in the market, and they both were long and short stocks, and that was kind of another wave. And now, as you described, there's this democratization of smaller investors being able to band together. And when I referred to this Davy versus Goliath, it was the small investor sticking it to the hedge fund, who are these wealthy folks, largely on either coast and in Chicago. So that's an interesting trend. And what I want to do is talk about something that is a more technical point, but I think it's a very technical point. And this is a question that came in from somebody in our audience. I'm going to try to explain it in a way that is understandable to everybody. And somebody asked about the circuit breakers that Robinhood put in place during the GameStop short squeeze and some of the other short squeezes. And let me explain what a circuit breaker is. It goes, frankly, all the way back to the New York Stock Exchange in the late 80s. Professor Harmon, you and I might remember a couple of days where the market went crazy and it moved an incredible amount in a matter of an hour or two. And so the New York Stock Exchange and other exchanges put so-called circuit breakers in place so that the market could take a pause, kind of digest where it was, and not get crazy out of control. And that was really exchanges and regulators doing that. I want to give that historical context because what this particular person asked about was the decision by Robinhood to essentially put their own circuit breakers on and suspend trades that people put on within Robinhood. And so maybe describe what that was all about and what your views are on whether you think it's appropriate for an exchange and really an app like Robinhood to have done that.
Sure. So first, I think that the circuit breakers in general, at first, it's important to realize that Robinhood is not a clearing broker. They only monitor and facilitate these trades of its users. They don't really clear the trades of the users. They outsource that work to a firm called Apex, which is a clearing broker. When Robinhood, AMC, Nokia, BlackBerry, and some other stocks that became extremely volatile during this time, Apex, as a clearing broker, had to protect themselves from being extremely liable for losses during this event. When a Robinhood user buys or sells an equity, it actually takes 2 days for that trade to clear. The highly volatile and high frequency trading that was occurring made it so that Apex couldn't differentiate which trades were being made on what's called settled funds and what was being made on unsettled funds, and also what was being made on margin, which are borrowed funds. Because of this, they had to halt some of the buying of these names, which is what actually happened, because the circuit breaker happened on a larger scale and happened on all exchanges. When a stock becomes way too volatile, markets have to pause to allow these trades to really catch up. They can't just let stocks move 100 points a minute, really. So yeah, because of this, they halted the buying on these names because they simply couldn't. Apex was the one who made this decision, not Robinhood. Apex, as a clearing brokerage, made this decision, and they made it because they simply could not take on all the risk on these unsettled funds. If millions of these trades went through with funds that have never settled, Apex was the holder of all this risk that they simply could not bear.
So
and
that's
also,
great.
it's important to realize, I just want to make this final point, that it's important to realize that Robinhood was certainly not the only one to make this decision. A lot of other brokerages made this decision. Like, I know, for example, Interactive Brokers made this decision. I'm blanking on some other names that also made this decision, but Webull also made that decision. So yeah, it's not a Robinhood thing. But what I will say about my opinion on all of this, I think it was handled poorly by Robinhood by communicating to its customers what was going on, and also the media communicating what was going on. I had people in my family who don't trade. I have friends and family who don't really trade at all, who don't pay attention to markets, asking me if I was going to leave Robinhood because of all of this, because they were suppressing their users and everything like that. And I was like, no, that's not really what's going on here. Robinhood's not making this decision. It's not only Robinhood that's making this decision. There's bigger things going on. That's not really being talked about by the media.
So that's a great explanation. And Professor Harmon, let me turn to you on the same topic and ask you in a broader context. Often when there are these kinds of problems, either the regulators make these decisions on circuit breakers and or exchanges, not individual brokers. And in this case, as Darius described, it was really individual brokers. And there is continuing discussion about how to regulate and whether to regulate these kinds of things. And frankly, whether individual brokers ought to be able to make these decisions. I can't imagine most institutional or individual investors want to hear from a very large firm like Morgan Stanley or Bank of America Merrill Lynch, sorry, we can't execute that trade that you asked us to make. We're just not going to be able to do it. So give the broader context, if you can, Professor Harmon, on your feelings about really whose responsibility is it to try to have these circuit breakers and to manage the chaos.
Yeah, so the circuit breakers, I think, as you had described them, Scott, was they were put in place by the exchanges and by regulators to protect market participants, to create a situation where there was a pause and we lost volatility. That's perfect. That is great. But each individual firm underneath that has their own responsibility to protect their own capital. And that's really all that was happening with what happened with Robinhood. Apex was protecting their own capital. And the reason that they had to do that is because these new smaller brokers that are starting up, the Weebulls, the Robinhoods, the public.coms, they don't have that much capital. So they can't cover all that risk. And that's why they've gone and hired these clearing brokers. Big brokerage firms like a Morgan Stanley or a Goldman Sachs or a Fidelity had that capital in place and didn't have to put those restrictions because they could cover the amount of trading that their customers were doing. So this is really the system of managing risk working perfectly, working as it should be. And Yeah, I understand the process where the individual customers feel like that maybe they got screwed. Maybe I held 10 shares of GameStop and they wouldn't let me sell it. And it's an issue, but it's an issue that you were informed about when you opened your account. Your broker, when you opened your account, told you that they could impose margin limits, restrictions in trading on any particular stock at any point in time. Most of us click the box and move forward without reading that, but it's out there. It's most likely to happen in these smaller firms that don't have that don't have that capital in place behind them. And one of the things that you saw around this whole event with GameStop was as it moved from a Friday into the weekend, Robinhood went and raised $1 billion in capital over the weekend to try and avoid some of this going forward. They finally realized that they needed more capital.
So, I want to move on to some other questions, but Darius, let me come back to you on one point that Professor Harmon said, which is that investors were informed of this. And it's like so many things that we deal with electronically these days. Do you agree to all the following? Check the box. You don't read the fine print. And think about it as an individual investor. You're a more informed one because of your educational background and your experience. But as you think about most of the folks who are trading on Robinhood, what's your personal feeling about the responsibility of firms like Robinhood to disclose all of this? I think folks now are well aware of it, but what is your thought on that?
Yeah, so I want to make it clear that I'm more like all the Robinhood users than I am a more educated investor. Especially because I come with a civil engineering background. So when I started
you've taken classes from Professor Harmon, right?
Of course.
And you're an expert. Come on, you're an expert.
And that's when I became an expert. But when I first started trading, it was about 3 years ago, and that's when I had no knowledge of the markets or how they work, how Robinhood works. And there were times when I was frustrated with Robinhood and the way they carry out closing trade processes. So one, for instance, is when I'm holding an options trade that expires on the day that I'm holding it, Robinhood will close out that trade at 3 p.m. And when this first happened, I didn't know that this was a real thing that Robinhood did. So I looked at my account, and a trade was closed at 3 p.m. on the dot. And if you know things about options become extremely volatile when there's not much time left on the option. So this option, it closed at 3 p.m. and it closed for, let's say, X amount of dollars. And I retained that, but then 45 minutes later, it closed for 10 times X amount of dollars. So I was really frustrated with Robinhood at this time. I went back and learned about Robinhood's process. I read the fine print. I read what Robinhood really does, and it is all there. It just, sometimes it does take an event like this to learn that Robinhood does have restrictions. Robinhood does have rules that are being followed, and it's to protect themselves, but it's also to protect the users. I've seen stories where people are trading on margin, and that margin comes out to be 6 figures in debt for them. And unfortunately, people have actually taken their life because of this. Yeah. Robinhood does this to protect the user, but also protect themselves. So it is a learning experience for everyone involved. Robinhood does have the responsibility of telling its users what will happen, but they do that in some sense, to be honest.
Okay, very good. Let me turn.
I could jump in there, Scott.
Yeah, please go ahead, Greg.
Because people talk about the huge growth in users in these platforms and all. Charles Schwab, another broker, did a survey of their customers recently. Charles Schwab has 31 million accounts, and they surveyed all of their customers and said, how long have you been trading? And this was just done last month. How long have you been trading? 15% of their customers said that they had been trading less than 1 year. So 15% of 31 million, 4.5 million new users at Charles Schwab. Think about that in terms of Robinhood. Robinhood is about half the account size, so maybe 2 million new Robinhood users, kind of exasperating this issue along the way as well. 2 million new users that hadn't had that experience, hadn't had the issues that Darius had already worked through, all of a sudden being restricted.
Yeah, that's a very good point. So let me move on to another very important topic in the business world and the investment world, which is really blockchain, Bitcoin, and non-fungible tokens, NFTs. And maybe, Darius, I'll start with you. As an engineer turned business person and investor, where did you see blockchain, Bitcoin, NFTs, either in your engineering curriculum, or how do you think about it now as an investor?
Sure. So I didn't know about Bitcoin much at all until I was at my Case Western basketball practice, which is filled with a bunch of finance students who were all talking about Bitcoin because it was blowing up at this point. It was just going through, the valuation was going through the roof, and I didn't know much about it. I tried to start doing some research, but realized that Bitcoin was just something that I would not touch at all. I would not invest in it until I learned more about it. So I learned that Bitcoin is essentially just cash for the internet. It's an untraceable transaction that provides security and safety for both sides of that transaction. And its power is really that it's totally decentralized, and it's thought to be both a hedge to standing currencies and also become the money of the future. In the same way that gold has value because people trust that there's value in it, cryptocurrency has value because people trust in the value of cryptocurrency. Without the trust, there's no value. So when big banks collapsed in 2009, Bitcoin emerged as a currency that had staying power because it became a currency that worked when the banks and current system started beginning to falter. Bitcoin has a transparent ledger so that everyone can see every transaction that takes place, but we can't see who made that transaction because it is pseudo-anonymous. So Bitcoin
it's transparent but anonymous.
Yeah, that's weird to think about. It's transparent because we can see all of the different transactions. We just can't see who made each transaction. So with that, Bitcoin does have some value in some nefarious spaces with illegal products being bought online because you can't really trace who's buying that product and who's selling it. But one of the spaces which this question is really which you asked about, that Bitcoin has revolutionized is the space of these digital products. So one of these products are the NFT, or the non-fungible token. The NFT can be described as items that are digitally allocated to its rightful owner. This can be in the form of a photo, a video clip, audio, or etc. And the ownership of the individual NFT can only be had by the last individual to have purchased it. NFTs exist in a free market, so the value of NFTs are set by the buyer and seller. There's no true value in NFTs. It's just like Bitcoin, is the value that people see in it. So yeah, it's weird. It seems weird that someone would find value in like a digital product like a photograph, because really anyone could take a screenshot of it and say that they have that ownership as well. But I like to think about the NFT this way. If like the Mona Lisa has a lot of value in it, and it exists in the Louvre museum in France, right? So, and it's currently very, very valuable, but you and I can go on to Google right now today and get a printout of the Mona Lisa. That printout is not valuable because anyone can get that printout. Just like the Mona Lisa, these NFTs, there's ownership. Someone has the actual ownership, and that ownership is is traced through blockchain, is traced through Bitcoin and other cryptocurrencies. So only the person who has the ownership has the actual valuable item. And there are some markets where there's some markets where there's actually some real value in it. And one that I'm involved in is the NBA Top Shot. That's one NFT that has made a big boom. Personally, I'm not as involved as I could be. I'm in touch with some people who have made six figures on NBA Top Shot, which are just basketball moments from the NBA, just different plays. It's a 6-second clip of an NBA play, and some of these NFTs sell for 5 figures just because people want to pay that.
Yeah, it's I understand the notion of that. I remember reading that, I believe, again, that's the New York Times, a columnist sold in NFTs the rights to a column, which are readily available. I mean, the Mona Lisa is one thing. There's only one physical Mona Lisa, but a digital column that you can get anywhere from free, and somebody to have the rights to that, and for that to sell, as you said, for 5 columns is a bit odd. So, Professor Harmon, let me turn to you, and we'll continue on this question. If somebody wanted to invest in Bitcoin, other cryptocurrencies, NFTs, where do they invest? How do they invest?
Yeah, so you have to go to an exchange to go and buy your Bitcoin, just like you would go to an exchange to go and buy a stock. You do it through a broker in the stock market or in the bond market. In the cryptocurrency market, you do it through a series of exchanges that kind of look like the stock market used to look like back in the 1970s, where there was regional exchanges, the New York Stock Exchange, the Philadelphia, the American, the Chicago, and the San Francisco. We have that now in the crypto space. So we've got one big one in the US called Coinbase. Coinbase is actually going public in the stock market today. But there's dozens of others as well. And each of them will allow you to buy and sell cryptocurrencies, exchange your cryptocurrencies for other cryptocurrencies, and hold your cryptocurrencies there. So that's how you get it. Once you have it, you can either store it right there at that exchange, or you can take it off the exchange to prevent the possibility of any electronic thievery or hacking or something like that, and put it in a cold storage, they call it. Cold storage is essentially, think of it as taking your digital information around the cryptocurrency you bought and putting it on like a thumb drive and pulling it off of the internet. That's what cold storage is. Hot storage is the other form, and that's leaving it at that exchange like Coinbase so that it's more readily tradable. Those are the major methods of doing it. And as we all know, cryptocurrencies have become very, very popular. The biggest ones we all know about: Bitcoin. Ethereum is probably the next biggest one, and that's really the basis. It's the technology behind all of these non-fungible tokens that we're doing. All of them are built on smart contracts within the Ethereum space. But there's 40, 50, 100 different types of cryptocurrencies that you could invest in.
Well, very good. Well, let's turn to the market overall. And by market overall, I'm talking about the stock market, the bond market, the housing market, basically all of the investing markets. And a lot of folks believe that somehow, despite the pandemic, almost every market is overvalued, and that we are approaching, whether we want to call a peak or the top of a bubble, much like we have several times in the past. Professor Harmon, I'm sure you have some perspective on it. Darius, you're a bit younger than Professor Harmon and I, and so haven't lived through as many of these cycles. What is your personal perspective on where we are, on where asset values are, equity values, bond values, housing values, all these sorts of things? Do you have a personal point of view on that?
Yeah, I mean, we're seeing all of those markets have different dynamics, right? So equity markets, if we look at equity markets now, we went through a pandemic where we intentionally shut down the economy, And now we're building it back up, and we're expecting to see really strong growth. And that creates some frictions in the marketplace. A lot of the money that's come into the marketplace has found its way into stocks, and stock valuations, if you look at them from a historical perspective, looking at the price to earnings multiples, so take the price of the stock in the market relative to the earnings that the companies are making, that multiple is right at about 40 right now. This is historically a very, very high number. It tends to average more around 15. So from that perspective, you would say stock markets are very overvalued. The caveat that pulls you back, though, is that price to earnings ratio is made of two numbers, a price and an earnings number. The earnings number is moving very quickly as well, as more and more analysts and more professionals are starting to get a better understanding of how fast the economy is going to grow. So there's probably two schools of thought on this now. One is that it is very overvalued. The stock market's very overvalued. The other is that prices are very high, but the earnings piece is going to grow into it so that the valuations will start to come down without the prices starting to come down. So we're going to have to see over the next 3 to 6 months how quickly the reopening of the economy has an impact on that. As you said, Scott, the bond market plays an impact in that as well. And if we look at what the Federal Reserve did to try and improve liquidity in markets and prevent a total crash of all assets during the pandemic, they essentially brought all interest rates down to zero through various methods, but we'll leave it at that for now. They brought them down to zero, and longer term rates are starting to rise back up now. There's concern that longer term rates rising will signal that inflation is starting to pick up. And typically when inflation starts to pick up, it's a sign of an economy that's overheating, so opening and running too fast. And when that happens, the Federal Reserve will do what they can to try and stop that from happening. So they'll try and cool down the economy, and they do that by raising interest rates. So the thought with rising inflation and rising interest rates is that maybe the economy is overheated and maybe it needs to slow down, or we're going to have runaway inflation and we end up being Venezuela or Zimbabwe, 10 years from now. Kind of a stretch, I think, because when you look at rates on longer term instruments, 10-year treasury bonds or 30-year treasury bonds, they're significantly below where they were at the start of the pandemic. Long-term or 10-year interest rates are currently at 1.65%. They were over 3% at the start of the pandemic. Goldman Sachs, the major investment bank, thinks that they're only going to get up to about 1.9% by the end of the year. So there's those two markets. And then the one that gets tossed in on top of that then is the housing market. And we remember that market more so because the housing market played a major role in the great financial crisis through 2008 into 2009. And we've all seen our housing values go through the roof. And it's been driven mainly by low interest rates, so mortgage rates being very low, and demand. We've got a whole demographic of millennials and Gen Z buyers that are now of the age that they're buying houses and they're moving into the marketplace, and there's just not enough houses for them. So the housing prices are getting bid up very quickly. As interest rates start to rise, that'll probably start to slow down a bit. And the big debate around overvaluation, is there going to be some kind of a crash or some kind of asset valuation reset, really stems around the timing around all of these different things. If you believe that inflation is under control and you believe that interest rates can rise a bit further, even up to double from where they are at 1.6 to 3.2% on 10-year rates, and you believe that companies will grow into their stock market valuations by continuing to sell more and more goods, we might have a really long path ahead of us to the upside in stock market valuations and in housing valuations, but probably at a much slower rate than what we've been seeing.
Yeah, well, I knew it was a broad question, and you gave a very comprehensive answer. We could spend an entire semester talking about that.
Exactly.
Thanks for touching on that. Darius, let me turn back to you and talk about, just from your perspective, the role that some of these technology solutions like Robinhood have played in really not only folks like you trading in the market, but really the impact on, to the extent you can speculation in the market. So give that perspective. Would you be in the market if these platforms didn't exist? Or would you be in to the degree you are and other folks, other folks you talk to?
Sure. So I think it's really the combination of these platforms like Robinhood and Acorns and SoFi and these platforms that make it easy for young investors to come in and participate in this market. I think it's the combination of that and also social media and it's in the sharing of ideas to be had at a instantaneously. I think that combination adds to a lot of the speculation in the market. I think a lot of the retail investors come in and they are the speculation in the market. And I think it's because today everyone is a financial advisor without actually being a financial advisor. So these social media platforms like TikTok and Reddit give the power to these people who have very, very little industry knowledge. They give them the power to be able to share these ideas. So I think that all of this brings people into this market and has people learning really by fire. I came in and learned by fire. I came in and I had a lot of success at first, but then I found that the market is extremely humbling. I had to learn for myself. I learned that I can't just listen to everyone on the internet. But yeah, what I see is that there's a big problem with a lot of people just blindly following strangers, a lot of people not doing their own research, a lot of people a lot of people that want this information spoon-fed to them. And with Robinhood, you're able to make these investment decisions really quickly without having to think about them. And because of that, I think speculation is really added.
Well, that's a really good answer. And yeah, hold on a second, Professor Harmon. It's a good answer. And I'll be a little sarcastic in saying, were you just talking about investing or life in general, of not believing everything you read on the internet and doing a little bit more thoughtful analysis before one makes a decision? That's a rhetorical question. Go ahead, Professor Harmon.
Yeah, I was just going to add in that there's one other piece of the whole puzzle that we haven't talked about around Robinhood, and they clearly revolutionized trading by dropping fees and commissions down to zero.
Yeah,
but
right.
They did one other thing as well, and what they did was allow you to buy fractional shares. Right. And for people like I don't want to say like Darius. Darius might have like $10 million for all I know. But for people with small accounts, they couldn't afford to buy one share of Amazon stock or one share of Tesla stock. And now they can. Now they can participate in every stock in the market, not just the ones that cost less than $25.
And so I think that's a really, really important point. And frankly, I think like so many innovators in almost any industry, whether it's Amazon in the retailing business or somebody like Robinhood in this market, it's really forced a lot of the legacy companies to respond accordingly. I mean, you can do the same thing now at Fidelity and Schwab and almost anywhere else, because you've had to be able to do that in order to compete against these other firms. So I think that's a really, really excellent point. There's one somewhat technical question. I think this will be our second to last question, and perhaps Professor Harmon, you can give a succinct answer to this because it's a fairly technical question. Somebody asked about what a fully paid lending program is at a brokerage account. What is it and what are the advantages of it? Because that's something that's also a relatively new phenomenon.
Yeah, so fully paid lending. Think about when we're talking about short selling and a short squeeze. In order for someone to sell short a stock, they're selling something that they don't have. So they have to borrow that stock to be able to facilitate the actual transaction, the settlement of the stock. You can create buy and sell orders in the market, but to be actually able to settle the transaction, you have to own the stock. The fully paid lending programs take advantage of those of us that own stock, allowing us to lend out to those people that want to borrow stock to be able to sell short. This is on an institutional, so a professional investing basis. This is done at very large scale. There's trillions of dollars that are being lent in stock market value around the globe on a daily basis. But it's just coming down to the retail investor now. So in this program, you lend your stock to another customer of the broker-dealer. The customer of the broker-dealer has an amount of cash as collateral held up against them. So think about margin, a margin account. The broker-dealer holds that margin aside. So in the event that that customer goes bankrupt or can't return the stock to you, they have cash to give you to buy back the stock. And as you lend that stock out, eventually, 1, 2, 3 weeks later, or even a day later, the person that borrowed it doesn't need it anymore. They close out their short position. They return the stock back. The broker puts the stock back in your account. That's the transaction, how it works. When you're lending your stock out, you get paid a fee for doing that. So
what's the risk? What's the risk of doing that? So, it's interesting if for a long time, as an investor, even a retail investor, you could borrow on margin. It's nothing more than, essentially taking the equity out of your house. It's just in your brokerage account. So if you have $100,000 of stock, maybe the brokerage firm would let you borrow $25,000, even $50,000 to put to work in buying additional investments. This is the opposite of that. You're actually, you're the lender instead of the borrower, and you're getting paid a fee to do that. Anytime you lend money out, there's a risk you're not going to get it back. So how do people participating in these programs have some assurance that they're not going to have a loan gone bad?
Yeah, so the assurance that you get about this is number one, the guarantees from the broker dealer. So their insurance company, SIPC, Securities Investor Protection Corporation, will guarantee customer accounts up to $500,000, I think it is, and half of that can be cash. So that's one aspect. If you are in that case lending stock out and getting cash for that, you're holding cash. Your only risk to you now is that you don't have the stock if you want to sell the stock.
Yeah.
And for most stocks, they're very easily substituted, and the broker dealer can find someone else to cover that short position. There will be some, like if it were like a GameStop, where the short interest, the amount of shares sold short was more than 100% of the shares outstanding, where it could be very difficult to do that. And then you might not be able to liquidate your position if you wanted to. So that's your risk.
Okay, that's a good summary. Well, I think our time is almost up. I do have one final question that I want to ask each of you. And Darius, I'll start with you. It's a pretty simple question, which is, if somebody was a first-time investor thinking about investing in today's market, what advice would you give them?
Sure. So I'll actually be working at Vanguard come summer, and I'll be I believe in their motto, and just that it's important to be involved in markets, and it's important to have a long-term view. So my advice for any first-time investor is just to really just be involved and not try to hit home runs, not try to time the market and out trade the market. when I entered the market a few years ago, the market was similar in that it seemed to make a new high each day. I actually thought that I would become a millionaire pretty quickly and that I would be able to drop out of school and become a full-time retail investor, but that's just not how this really works. Anyone who tells you otherwise is probably lying to you. The market is extremely humbling, and I had to learn that for myself and learn that losses will happen. And if you don't have a plan going into your investments or trading decisions, these losses can be exacerbated.
So
This is
go ahead.
This is real money that we're using, and this real money that can build your future. I remember that one class that Professor Harmon had when he said that everyone wants to try to trade, everyone wants to try to invest, but they should understand that this is real money. This is the real deal, so you can't just play around with it. So yeah, I think it's important to just diversify, to have long-term goals, but also just to be involved. We have all these platforms that we talked about today, mainly Robinhood, but I think a great one that I put most of my money into is Acorns, because with that, they'll invest your money for you. Have to think about a single thing. They invest in the way that every investment course teaches you, to be diversified, to average your money in over time. So I just believe in Acorns a lot. But yeah, I think it's just particularly easy to get involved now. So there's really no excuse to start building a future now.
Well, I think that's good advice. Before I turn it over to you, Professor Harmon, Warren Buffett calls compounding the eighth wonder of the world, and he's done pretty well with compounding over his long life. So, Professor Harmon, let me turn it over to you to answer that question, then we'll wrap things up.
Yeah, I think I'm going to have a very similar answer to Darius, in that you have to be involved. You have to get in. And this current age makes it so that it's so easy to get involved. And I would say even outside of just stocks, try everything. And you might say, okay, Darius just told us this is real money. We don't want to just play around. But you're in an environment now where you can try out the stock market for $25. You can try out Bitcoin for $5. You can try out non-fungible tokens. Try it on NBA Top Shot for $10. Go to Rally Road and invest in classic cars and trading cards. Go see what it feels like. It's important to get a feel for what it feels like to have money at risk as well. And it's a perfect environment where you don't have to have a lot of money at risk. You can have investments in 100 different things and it totals $150. So this is the time to try it out.
But I think you're both saying that is terrific, but don't bet your life savings just to figure, just to give it a shot. All right. Well, I want to thank both of you for your tremendous insights into all of the topics we've talked about today, because we've talked about a number of them, and we appreciate you sharing your time and in particular your expertise. For our viewers, thank you to those who shared questions, and for the rest of you for joining us today. If you have any additional questions or comments on today's subject, please pass them along to Brad Cruz and the rest of the folks in our Alumni Association. There'll be an email address that will be displayed on the screen momentarily. So on behalf of the panelists, I want to thank everybody for participating, and we are looking forward to being off of Zoom and back in the real world, hopefully soon after the pandemic calms down. Thanks for your time. We'll look forward to seeing you soon.